Francisca, agora é com você.
Olá. Hello, everyone. Let's change to English. Hello, Gargi. Good afternoon. Thank you very, very much for joining us today. We are very glad to have you here. And also, Walter, thank you very much for joining us. It's an honor to have this panel with you guys, two great specialists.
Well, it's a pleasure to be here. Thank you for the invitation, and happy to share this panel with you.
Well, let's start with a quick bio from both of them. Gargi has majored in accounting from the Ohio Wesleyan University. She's a BlackRock managing director, head of a share investment strategy and markets coverage, with over 2 decades of experience in the financial services industry. Gargi has built her career around portfolio management in fixed income markets, trading, and macro strategy. She's also a LinkedIn top voice, and I already learned a lot following her, so I recommend you all to do the same. It's very interesting. Walter here has a major in economics from Rio, OPM from Harvard, just concluded, father of 5, one of the few people that has more kids than I. He started his career as a trader and PM from desk in Safra. In 1995, joined the legendary Banco Garantia, and later, in 2006, joined EasyQuest, a 27 billion reais Brazilian asset management firm, which has been a very successful CEO since 2011. Well, said that, Gargi, let's start with your favorite topic, Fed. As you mentioned last week, markets started this year is expecting 7 cuts in the Fed fund rate. Now we expect 2 or less moves. So what's the base case for the Fed in the second half of this year?
Sure. And hi, everyone. It is very good to be here, even though not in person. I apologize that I'm not there in person. It does feel very awkward. I can see the sides of the screen, and it does feel very awkward to have my face there in the middle of the room. But hopefully, I will make up for that by sharing some good insights with all of you. So I'll start that by talking about our views on the Fed, and especially on a day like this, it's important because we did have CPI, which, as we know, is one of the biggest drivers, inflation being one of the biggest drivers of what policy for interest rates, as well as, of course, for returns in equity, as well as fixed income markets are going to be. So with that, what are our views on the Fed? So, coming into this year, we definitely were very surprised when the market was pricing in 6 or 7 rate cuts at one point, because inflation, while it was coming down, was still very far away from the Fed's target of 2%, as we all know. We remained at, coming into this year, we called, even when rates were priced in at 6 or 7, we talked about 3 rate cuts in 2024. And right now, we have moved away from that 3, and we're a little bit closer to, or we believe we're likely to get 2 rate cuts by the end of 2024. So we've moved away from the 3 rate cuts. We were never in the camp that we'd see any higher than 3 because of the stickiness of inflation. And right now we're recognizing, and it's always a good time to think about what is new in the market. Where have we been wrong in the market? What we didn't get right in the market? And one of the things that we didn't understand that has been a little bit of a surprise to us is how sticky inflation has been, particularly that shelter inflation component. So what we all pay for rent and how that's calculated in the inflation basket has just been a lot stickier than we had expected. And I think it's taking a lot longer to come down. That will come down. Our expectations are for PCE inflation, which is the Fed's target that they like to look at. It's their preferred measure. Our expectations are for that to come down to 2.7 or 2.8% on core PCE by the end of this year. So still not at 2, but a lot closer than we are today. And because of that stickiness, we think that the Fed will only be able to deliver 2 rate cuts. So anytime the market is pricing much higher than that, if they get to 3 or 4 rate cuts, I think that's a good opportunity for us to take the other side of that. And anytime the market prices in 0 or 1, that's a good opportunity to own fixed income. And we'll talk a little bit more about our views in the market in a little bit. But anytime we get too far away from that, I think that's a good opportunity for investors to take advantage of what is being priced. And I'll stop right there.
Perfect. Yeah, it's Dave, with more and more news about CPI, and we still didn't see a consensus about that, right? And Walter, so how do you think that this high interest rate environment affects the global scenario and meaning our investments from your perspective?
Well, first of all, we completely share this view. We believe that economics is a science. So, a few years ago, people believed that Phillips curve was dead. We wouldn't have inflation, never again. Inflation was back and strongly, very, very strong in all around the world. And what we see in the U.S. is labor and services still very pressured. But we are already seeing in the other sectors in the real economy that inflation is starting to give in. So I believe that this scenario could suddenly change and maybe get people unprepared. People are very, very defensive. Of course, high U.S. interest rates are going to put pressure all over the world, especially on countries with the fragile fiscal side, which is, by the way, our Achilles heel, right? So this will demand a larger risk premium all around the world. But especially talking about Brazil, when we look at the last 20 years, our average real interest rate has been 3.8%. This including Dilma Rousseff period, which was a total tragedy and disaster. So now Roberto Campos Neto is saying that 4.5% should be the natural real rate. So if we're expecting inflation at 3.4 for next year, rates could be as low as 7.2% according to this calculation. But the fact is that with the US running around 5%, we would have to remain closer to 9.5%, 10%. So the moment that US inflation starts to recede, what we're going to see is a complete change of risk appetite all over the world. So what I would say is that everybody's already scared and cautious, but be prepared, because when this happens, we're going to see a sudden shift, and countries like Brazil can suddenly appear very, very, very cheap. Remember that price earnings of the Brazilian companies as of this moment, 5 years, except for the 2002 election. So as of now, we are cheaper than in April 2020, when we didn't know if we would have vaccines, if the recession, would be there for years. People were at home, so it really makes no sense.
Yeah. Yesterday, I don't remember who, I'm sorry, but one of the asset managers that shared a panel here mentioned that Brazilian equities markets is more correlated to the Fed fund rate than any other.
We are completely Fed dependent, but I believe that this is true for the equity markets. This is true for currencies. And of all the emerging market currencies, the one that appears to be most devalued relative to the trading terms is the real. In my opinion, the real is 25% cheaper than where it should be. If you look at what we export, at the price we export to what we import at the price we import, we've always been correlated to the trading terms. Since the mess with Bolsonaro's government, there would be a coup d'etat, no coup d'etat, the thing started opening a gap, and the gap now is wider than ever before. So I think interest rates, equity markets, and the currency could benefit greatly from U.S. inflation starting to, show signals of converging.
We hope so.
We hope so.
Yeah. And Gargi, in this scenario, from your perspective, we are also living a period of a very tight monetary policy here and everywhere else. So what's BlackRock outlook for this investment landscape? And if you could complement in your view to the emerging markets as well, would be very helpful.
Of course, sure. And actually, before I jump into that, I'll just make a comment around what Walter was saying, which was so absolutely true in terms of how much the U.S. has been a central bank for the world as opposed to just a central bank for the U.S.
Perfect.
And that's not true for just Brazilian equities, right? That's obviously true for equities across the globe. And I think that's exactly the reason the Fed takes their responsibility very seriously. And that's exactly the reason why I think any further rate hikes from here are going to have a very high bar. Never say never. We can never say it'll never happen. But the bar for the Fed, especially after they've brought rates up to 5.375%, to move rates even higher is very, very high. And actually, you keep hearing that from the Fed over and over again. They actually want to cut rates. They just need the data to cooperate. And today was the first step in the right direction, with CPI coming in a little bit weaker than what the expectations was, coming back down to this 0.3% month over month. Now, tying that all in with the U.S. interest rates remaining so restrictive. And what I mean by that, of course, is U.S. rates at 5.375% is significantly about 300 basis points higher than what the neutral policy rate or the neutral nominal policy rate of approximately 2.5% is. With that restrictive place where a policy is in the U.S., how one allocates in both the equity market, commodity markets, as well as fixed income market is going to remain really, really important. So how are we thinking about it? First of all, in the fixed income market, which is an area of the market that we have favored for the last four or so months, we think investors are getting this incredible opportunity to earn income. So really focusing on the second part of that word, fixed income, especially if you're sort of in the front end or the belly, what we call the middle part of the interest rate curve. So sort of looking at the 5-year or the 3-year sector, where you're earning a lot of income, where you're earning a lot of coupon, but you're not taking a lot of interest rate risk. You're not taking a lot of duration. We think that makes a lot of sense. So you don't necessarily need to own a lot of duration right now. You don't really necessarily need to buy 10 years, 15 years, 20 years of duration, because the curve is so flat right now that you can earn that in the very front end. I was just looking at the math in preparation for this. So if 2-year interest rates moved up by 100 basis points. So a full 100 basis points higher than here, which is not our base case. But even if that were to happen, you could still make money owning 2-year treasuries, because that carry, that coupon of the bond is so incredibly attractive. So own fixed income, own high quality fixed income. So we really like investment grade bonds here. We definitely like emerging market here, especially on the local currency, to Walter's point around how many areas of the world have actually had cheapening currency given the strength of the US dollar. We really like certain parts of the securitized market, but all of that very important to keep the duration managed to around 3 to 5 years. So that would be one of the areas that investors can take advantage of. And then moving to the equity part of your portfolio, I think, again, this is where quality matters. So what we've been telling investors to do in this high yield environment, whether or not the Fed begins to cut, they are not cutting back to zero anytime soon. Even when they begin their cutting cycle this year, next year, they're only bringing interest rates down to, call it about 2.5% to 3%. Outside of an exogenous shock, of course, we're not going to see that 0% rate regime that we came from. So in this new era of somewhat higher policy rates, I think it's really important to focus on the areas of the market where you can see most earnings growth, to focus on the areas of the market that we call high quality parts of the market. So stable earnings growth, lower leverage. That's really important when rates are staying high. Lower leverage is going to continue to matter. And free cash flow. That obviously is also important when you're in an area or in a regime of higher interest rates. So that's how we're thinking about the portfolio. As I mentioned, much of this is focused on keeping your portfolio up in quality. And then I'll also say that there are 2 really cool opportunities that I'd love to talk to you a little bit more about outside of broad EM and fixed income and equities, which is really looking at some emerging markets, the ones that we like in particular that we think will work for some time, is actually both India as well as Mexico for many reasons, such as friendshoring, such as geopolitical fragmentation. And then the other one that we think is just at the beginning and beginning of some massive shifts is Japan. That is an area of the market where, with the Bank of Japan starting to shift policy, with inflation beginning to come back, and with the under-invested macro investors, I think Japan and India both have massive opportunities for investors to focus on for the next few years.
Perfect. We'll get back to that later because I'm very interested in that as well. But let's move to a more spicy topic. Unfortunately, on top of this high interest world that's already not easy to deal with, we have a very geopolitical tension around the world. So Walter, first for you, we have several issues around the world, but mainly China and Taiwan maybe has a major effect on the markets. And I think that you have a wild card about that in 2004 scenario, and could be very disruptive. So what are your thoughts about it and how it's reflected in portfolios? Question. Yeah.
Well, it's interesting how those questions are all correlated. So addressing her point, the part of the curve that we wouldn't be playing in the US right now is the 10-year. And I totally agree. 3 to 5 years, you can take a lot of profits. Here in Brazil, you have NTN-BIS, the long ones.
Inflation-linked bonds.
Yeah, inflation-linked bonds paying today prices similar to Dilma Rousseff's period when the economy was, having 18 quarters of consecutive recession. So, I think it's very easy to take premium here. But the 10 years in the US, I would refrain, especially because the big buyer, China, is not buying anymore, and I don't believe will buy again. What we're experiencing in terms of geopolitics is a trade. It's not a trade war. It's a geopolitical war. Is a Cold War between China and the U.S. And this Cold War will be there, I don't know, for decades. I believe that what's going on with Taiwan or with North Korea, even with Russia or Iran, those are pawns and part and collateral effects of this dispute between the US and China. So I believe this is something that won't go away, and we have to be prepared. And of course, many countries can take opportunity. Nearshoring is a consequence of that. China is paving the way for India to be the locomotive of the world economy. And India is already benefiting from that. Mexico as well. And I believe that Brazil could benefit, especially if we remain neutral. The risk we have is if the world takes Lula seriously. I'm very, very happy that until now, nobody really cares. So Lula can, I think after the disasters about Hamas, disasters about the declarations about Ukraine, Russia, now he's more quiet. And if the government understands that being neutral is fantastic for Brazil, because especially our position as a huge exporter, even if Trump arrives, can be even more dangerous. I believe we have to remain neutral. Regarding China, Taiwan, I have a dissonant view here. I really don't believe China will do anything. If they do, they will create the perfect incentive for the U.S. to make, massive investments to substitute Taiwan, which will take a long time, but we'll have to, through India, through Mexico, and through the U.S. So I think it would be a losing proposition for China. What we do in the portfolio, when I talk to friends, I love Nassim Taleb's Black Swan book. But I don't see any value in the book because you can't hedge for everything. If you start hedging for those kind of events, your fund will probably lose a lot of money. So we try to hedge for things that we perceive as a risk, and we see as an immediate risk. I really don't believe that we're going to see China invading Taiwan, in the coming months or years.
Perfect. Gargi used a term that I think that's very assertive, that's geopolitical fragmentation. As I have been studying, it's one of my 5 mega forces we see playing now. And even if Walter is correct, it's something that we can deal with. But even though, how does this affect the investment opportunities, mainly in emerging markets as well?
Yeah, so I think that this is a really important mega force. And again, for those of you who are not as familiar with what we mean when we talk about a mega force or a mega trend, it's just these big ideas or big thematics that can stay with us and be a driving force for the market for decades, not just for the next quarter or for the next year. So geopolitical fragmentation is obviously one of those, in addition to many others, such as, obviously the rise of AI and climate transition. Those are all big things that we think are going to be here and drive investment performance and our portfolios. So we should always consider that. But geopolitical fragmentation, while it is a mega trend and a mega force, it's actually impacting our portfolios even now, right? So even though it's something that can impact our portfolios in the future, it's impacting our portfolios now. Just look at what commodity prices have done year till date, right? So how do we think about that? So first of all, if we think about the backdrop from where we've come, there was a period of a fair amount of stability post-World War II, right? And now if you think back to what we've experienced just over the last 5 years, we've sort of moved away from having just one or two major forces in the world, but we've had these pockets of bipolar strengths that are coming up. And obviously, US-China comes up a lot in conversations, whether that be just in terms of friendshoring or what that might mean for your portfolio. I think that has much larger implications in terms of what that might mean for inflation, to the extent that every single company is going to bring their supply chains closer to closer to home, to either back to the US or to a country such as we saw with Tesla and Mexico, to a country that is closer to home or a friend that is going to have an impact on pricing power, that is going to have an impact on efficiencies, that's going to have an impact on productivity. So I think that these are forces, and when I think about how this is going to drive investment performance, I think we have to think about how is this going to flow in through the inflation perspective? And then I would also say that we have to remember that this is there's going forward, there's going to be a focus on national security and resiliency over economic efficiency. So can that continue to drive? I think that is something that investors just have to get used to. Now, again, that does not mean that every single month will have VIX over 20 or whatever, but I think it just means that expecting a world where geopolitical forces will be a big driver and can drive oil prices, can drive inflation as a result of that, can maybe even drive monetary policy as a result of that, is going to be with us and impact our portfolios. So thinking about what could be uncorrelated assets, I think thinking about uncorrelated ways in which you can enhance the returns of your portfolios will be really important going forward, because correlations are going to break or are going to look different than they have looked before. Bonds and stocks have already not have the same have had the same correlation as they have had historically, because inflation is higher. So bonds may not be giving you, or at least long end bonds are certainly not giving you the same correlations as they had before. So thinking about uncorrelated assets in a world of higher volatility and perhaps even slightly higher inflation. And then, and those uncorrelated assets, by the way, could be commodities, that could be hedge funds, that could be liquid alternative assets, which is something that we're seeing a lot of investors focus on. And then I think understanding where your risks are. I think having a full view of, this is, if US and China are the bipolar forces that are driving the world's geopolitical fragmentation, what does that mean for my portfolio, and how much exposure do I have to other countries that will benefit? So, I know Walter earlier was mentioning Brazil, but certainly in terms of Mexico, in terms of India, in terms of having exposure to places like Japan, again, uncorrelated and can be really beneficial in your portfolio.
Perfect. We just mentioned that a few minutes before the panel, how we have get used to deal with the unpredictable. It's not only volatility, but you have major events like what's going on here in Brazil, unfortunately, but also from many sides, and we just got used to it. And this is going to be the reality for the next years, probably. And in this context, Walter, could you add your thoughts regarding this, but also talking a little bit about this trade war? You mentioned how this has been affected, and if the U.S. election can impact on that, be benefit for Brazil and other emerging markets as well.
I think the U.S. election can have an impact, but I believe that either candidate winning, the trade war will continue, and Brazil can benefit from that. Of course, if Trump wins, and today looks very likely he will, if nothing changes, ceteris paribus, this would accelerate this polarization. And of course, I think for Brazil, whoever thought, I'm in financial markets for 34 years, I've never thought that we would have $98 billion of trade surplus ever. Right? So Brazil can change in 5 years, and we can look back and the country be unrecognizable from now. And we are very, very pessimistic as of today. So when we look at our trade balance of this year, 2024, for the first time ever, oil will be the #1 item. And 4 years from now, there's not a guess, it's a projection from geologists. Brazil will be producing half of Saudi Arabia's production. We will become the world's 4th largest producer, but the U.S. does an export, and we become the 3rd largest exporter, together with being a strategic producer of food for the rest of the world. So having all that, having iron ore, having steel, and all the products that we export, if we take care of the fiscal side, and this is a major if, Brazil can be completely changed 5 years from now if we behave and take benefits from being neutral, especially amidst of having China and the U.S. as huge partners. As we were talking before, and we've experienced this in the last 24 hours with the firing of the Petrobras CEO. What I like to say is that volatility has a price. You can hedge. There is the VIX index. There are options, calls, and puts that you can buy or sell. But this is one thing that you can hedge. Imprevisibility, when you cannot, things are not predictable, there's no price. The cost is infinite. And what this government is doing right now is really scaring investors to the point where we really don't know what's going to happen. Even the Supreme Court recently has decided that items, fiscal issues that they have decided, if they change 5 years from now, we'll have to pay. So this becomes a kind of risk that is very, very, very difficult to hedge. So I would say that the fiscal side for us is the big if. But looking back last year in January, the government would change the inflation target from 3 to 3.5. It didn't. They would remove the independence of the central bank. They didn't. It was impossible to do a fiscal, a tax reform. We did. They would revert the Eletrobras privatization. They didn't. They made decrees that would damage the suing mark. This was reverted by the Congress in the morning. So what's more painful for us is that this government is barking all the time and not biting, but they're always threatening and menacing the market. So, of course, this has a very, very killing aspect of the spirit, the animal spirit, that brings investors to become more hungry towards risky assets.
Yeah.
And the way to hedge for that you asked, for us, the way to hedge for that is having a very diversified platform of products. We've been growing constantly in the last 4 years, because if investors are not looking for macro funds or equity funds, we have the private credit funds, we have infrastructure, we have agro, we have real estate. So having a diversified platform of products is the best hedge you can have in a country like ours. As Pedro Malan has said, not even the past is predictable.
Yeah, perfect. And Gargi also mentioned that there is nothing to do in this scenario than correlated diversification and our main steps of investment. And well, on top of our fiscal issues, I think that we have also major case on infrastructure. We have later today a panel, and we brought that, Gargi. But also I have read an excellent article you wrote, and it was issued by BlackRock. I don't know if it was this week. Well, it's a very recent article talking about India that you mentioned before. And I didn't know that India is probably going to be the third largest economy in the world by 2007. And I think that some points that your remark was the investment in infrastructure and how it has been changing. So can you share with us your thoughts on that and what we can learn from this case?
Yes, absolutely. In fact, I was just in India, which is where I'm from, if you can't tell from the accent. And, I wrote this paper right after I came back because I realized so much of the things that we as investors talk about in theory, right? We're like, oh, infrastructure and digitization. When I was in India at home in Calcutta visiting my parents, I could actually see some of that in reality. And I'll start with, infrastructure, which is, of course, a big driver of growth in India. And if you think about how many kilometers of roads are being built every single day, and it's not just roads, it's repairing of roads, building new highways, building bridges, connecting and repairing different underground metro systems, all of this in an effort to bring far-flung cities closer together so more people from the lower and middle class can sort of at least have access to the city, even if they don't move to the city for better job opportunities. Why does that matter? It's good for consumption. It is good in a country where, as we all know, and everyone knows about the demographics already, it is one of the countries with the most number of people under the age of 35. And as a result of that leads to an impeccable amount of growth. And by 2027, as you pointed out, it is going to be one of the largest drivers of growth. And that's obviously something that is really meaningful. So infrastructure is big, demographic everyone knows about, but I think it's broader than just thinking about infrastructure and thinking about demographics. It's also digitization, which is, of course, another one of the mega forces that we often talk about. It is this young population of people that are under the age of 30 and 35 that are able to and are very quickly adopting to this new age of AI. If you are in the streets of Calcutta or anywhere in India, even if you're buying fruits and vegetables from a vendor on the street that's selling fruits, you are paying on your app. That certainly wasn't the case 4 or 5 years ago. And, 10 years ago, most people didn't have cell phones and they didn't have home phones. Now people have moved away from having home lines to directly going to having a mobile phone and all form of payments. In fact, it's very difficult to transact in cash anymore. Again, why is this good for your investment in the public markets? Is because it moves more and more of people to the formal economy, and then again, is very conducive for consumption and growth. So the growth story is impeccable. Obviously, there's also an election story. India is going through one of the largest elections right now. We're going to get the election results in about a month, a little less than a month, on the 4th of June. And regardless of the outcome of the elections, I think one of the things that we have often found is post-elections, investors just feel a lot of certainty. There's a huge amount of uncertainty, both in the US and in many other countries and across the world that are going through elections right now. There's uncertainty going into an event. Once you've got that event past you, once the election's gone, I think people feel a lot more comfortable. So those are all the reasons, really, thinking about growth, thinking about infrastructure through the lens of consumption, thinking about digitization through the lens of consumption, and then obviously having the story of a very young demographic that is very apt to use AI and digitization for productivity is some of the other reasons why we think investing in India in both the private as well as the public markets are just an incredible opportunity and will be for some time.
Great. Well, talking about the megaforce, so AI is not a theme that we can escape from it. And Valtteri just come back from your OPM in Harvard, told me that you have learned a lot about it. Can you share with us? I think that actually Gargi mentioned how we have these major forces as well, making GDP lower, but in the other side, we have AI impacting productivity and GDP at the end. So how do you see this, and what's your perspective?
I see this as a major opportunity. Basically, you were talking about Harvard OPM. They make the case of, repeating this exhaustively so that you get the concept of forgetting about artificial intelligence and thinking about augmented intelligence. It's not that the robots are not ready to substitute the human beings. Human beings, in the end, will keep taking the decisions. But what we're going to have is much, much better data that can help not only economies, but help companies to be better run. So I think all of us entrepreneurs can have to adapt our companies to the future by using artificial intelligence, not only as we did in the past, which was having data to look backwards, but now with AI, we can use data as a predictive measure of desires of your customers, of trends, and things that you can shift. And this can have a huge impact in portfolio management. So what I see is a major rise of productivity. And this, I believe, will have a much higher impact on global GDP than the risks of unemployment and things associated. I don't think we're still there. So I'd rather think of augmented intelligence than artificial intelligence. People are too much in love with ChatGPT. I think that what we're going to see, especially in the US, in India, is a very, very fast increase of productivity. And of course, this is a signal of economic development and growth.
Yeah, I think we have been living that. We are for the last 12 months expecting a harder landing, a soft landing, some kind of landing in the growth
there was no landing
the world.
at all.
Until now, we haven't seen any landing, and we have seen this machine moving the economies and many equities markets in the US. And thinking about it, Gargi, but as well what you talked about India, do you think that India and other countries and all these evolutions could make the times for what China has done to the world? India can replace China somehow, or the other forces that we are talking about to keep this growth a little bit better than we are expecting for the other portions? Do you think that we can have these forces that keep the machine of the world moving and increasing GDP growth?
Yes, absolutely. I don't think the right question is whether or not India is going to overtake China, or India is going to overtake, or China and India are going to overtake US. I don't think that's the right question. I think the right question that we should all be asking ourselves is where is the what are the areas of the world, and I call this, or many other economists call this, the rise of the rest. Where is the new engine of growth going to come from? So it doesn't matter who's higher than who, but what really matters is, do you have enough allocation to the areas of growth that are going to drive forward growth in the next 5 to 10 years? So we all know that what potential growth of a country is driven by is demographics and productivity. So how many people there are in a country and how hard they work. Now, in the US, we've obviously seen productivity numbers, thankfully, over the last couple of years pick up, but there has been a pretty big decline in fertility. So the demographics has been an issue. And that's the same with Europe as well, where there is a decline in fertility, which is why demographics is an issue, which is why we turn to areas of the world, such as India, such as Mexico, such as parts of Southeast Asia, where demographics are actually really, really good. And as I pointed out, India is obviously one example, but there are many other examples of the world where demographics are now going to be very positive for the drivers of growth. So I think the question to ask ourselves is not who is going to be the biggest drivers of growth, but I think it's going to be around, do we have enough exposure in our portfolios for the areas of the world that the most amount of growth are going to come from? And some of that is obviously in the frontier markets, can be in the continent of Africa. Some of that is in Southeast Asia, and hopefully countries like India and Indonesia and Mexico and Saudi Arabia are all very much a part of your portfolio today, and make sure that they're going to continue to grow as a part of your portfolio as those markets grow, and more importantly, as the investors in those countries themselves become investors in their own markets. So Indian investors investing more and more in the Indian stock market will be a big driver of India, as opposed to US investors or Brazilian investors, or I should say, in addition to those investors investing in the market. So making sure that the engine of growth has as much a place in your portfolio as a country like China might have had 5 years ago or 10 years ago. Making sure that you're thinking about allocation in the right way.
Perfect, perfect. Well, for the last major force, maybe we have to talk about this very tragical climate change impact that we have here in the south of Brazil, with the biggest flood ever. And also we have heard today that it's much worse than the Katrina impacts in the US. And I think that is something that we're never prepared to, but mainly in Brazil, I think that's the first time where we have ever seen some real impact in our lives, in our GDP from a climate change event. So how do you see that, Walter? Can we deal with it in somehow? How does this affect our portfolios and so on?
Again, I think it's very similar to the other answer I gave. It's very, very difficult to hedge yourself from those kinds of events. What you can do is have in your portfolio investments that were in areas, in places, in sectors that you think are more protected. For example, we have several agro funds. None of them has great exposure to the south end of Brazil, because of the dependence, pure dependence on rice production. So we are much more spread towards Mato Grosso, to the interior of Brazil, to soya, and to agro products that are more reliable. And I think in that sense, you can even have gains in your portfolio when people start differentiating those things. But in terms of hedging, for example, for the loss of GDP that we're going to have, is very difficult because those events are unpredictable. So what we can see is we have in our infrastructure portfolios lots of investments in clear energy, in power generation, in solar and windmills, and this is the kind of thing that certainly will have much more attention and focus of governments and decision makers due to those kinds of risks. This is already happening. So I believe for us that there are lots of opportunities. And we were talking recently about infrastructure. This is one interesting thing. If there's one thing that the Labour Party, the PT Party governments have always brought was a surge in infrastructure investments. This is very key to their agenda. And interesting, even in the Dilma Rousseff government, the rise in infrastructure was mostly on the private sector rather than the public sector. As we know, in Brazil, 95% of the resources are already taken by expenditure. So there's no money from the government to investments. Right. So those investments will come from the private sector. And when we see the strength of the agribusiness in Brazil, there's a huge demand for not only depending on transportation by trucks, so we're going to have to use our rivers, we're going to have to create railroads and other kind of, we have to stock our production, and today the silos that we have are only 65% of the total production. In the US is 115%. And those investments have been made by private investors such as us, that we are very confident that have much higher productivity and efficiency than the government investments. So I believe that very difficult to hedge yourself from those risks, but it's not very difficult to take benefit investing in the right stuff that will appreciate and have more value because of those risks.
Perfect. Well, we are in our last minute, but we still have time to a little more questions. And Gargi, I would like to listen to you. You have talked about mega forces, too many things happening in the same time. I usually joke with my colleagues that we have already experienced a lot of things in our career. Pandemic, war, it's okay. I'm fine with the experience. We don't need much more. But we all talked that we are not at the same time expecting things to get much easier in the next days. So with all this context, do you think that we have change in our decision-making process in investment, or how does all these forces have been impacting our decision-making process? And also, what do you think are the biggest opportunities right now in terms of investments? We mentioned some, but if you could summarize to us, it'd be great.
Yeah, sure. So I think that, yes, there's always investing that is changing. And I think any of us that have been investing for the last 20, 30 years, we are different investors today than we were when we first started our careers. So investing is always changing. We have more data at our fingertips. We have to be faster. We use different, today it's AI. Earlier it was high frequency trading. There's always changes. There's also the macroeconomic shifts. We talked a little bit about, how the geopolitical fragmentation can change how inflation is. It can change correlations. The one thing that I think does not change, or I don't think that has changed so far, is the benefits of being diversified. I think that is something that both Walter and I spoke about. I think having a lot of uncorrelated assets, because asset classes and their correlations to each other can constantly change in a world of so many mega forces. Just if you think about the fact that last year, if you didn't have access in the US to the Magnificent Seven, you were actually down on the year. And if you did have access to them, you had a magnificent year. So I think that's something that could not have happened if, that's something that you would have done better in if you had other types of assets in your portfolio, if you had private credit in your portfolio, if you had hedge funds in your portfolio that were able to do well. So remain diversified, seek out parts of the market that are uncorrelated to each other. And I think always continue to think about new ways in which data can be incorporated into your investment process. And then just to reiterate all of the points that I made earlier, once again, I think I'll end with saying that these are some incredible opportunities for the fixed income investor. I think that when we look back in 5 years or even 5 months, I think the yields that are available in the fixed income market, especially when you look at, credit markets, emerging markets, securitized assets, high yield markets, when you look at the all-in yields, the lack of duration, or the fact that you have to take such little duration risk to earn 7% in high quality assets in the US is actually incredible. So I think keeping your portfolio with a high coupon and then keeping growth assets in your portfolio with a high quality bent make a lot of sense. And that's how I would tell investors to position.
Perfect. And Walter, do you want to share with us your thoughts about the biggest opportunities and the decision-making process?
Well, I think the decision-making process hasn't changed for us. I mean, Brazilian managers are used to volatility, to imprevisibility, to have always to be very, very careful about the macro scenario, the political scenario, and the global geopolitical scenario. So this is a factor for us all the time. And the Brazilian economy has a lot of asymmetries, including asymmetries of information. Basically, this is the big reason why managers in the US don't beat the indexes, and managers in Brazil often beat the indexes. Our small mid-cap fund is probably in the last 15 years yielding 10 times the Bovespa index after all taxes. If you think of Brazil of the last 12 months, we're very pessimistic. No, things are in a horrible shape. Our long bias fund is returning 27% in the last 12 months. Our long-short fund with no directional exposure is yielding 19.5%. So our job is to identify the risks, identify the opportunities, and buy the right things. When you do that, returns will come. But listening to what we've just heard, if there's a compression in the U.S. rates, if U.S. inflation starts to recede, what we're going to see here in Brazil with those high long-term yields, for example, you have all those event products, Painel, CDI plus 5, CDI plus 6, products that if you start seeing those compression in rates, you're going to see the coupons going up heavily. So I believe that the market right now is very, very worried about the U.S. rates. But as we've heard, we share the similar views. I think that this could change very fast. So the key is being diversified. Being diversified minimizes the risk of losing the trend.
Perfect. Well, thank you very much. Unfortunately, our time is over. Gargi, it was really, really great to hear for you. Very precise and very new thoughts for us, despite in the end, the lesson is the same for the last 8 years, diversify. And Walter, thank you very much as well. It's always a pleasure to be with you. We are in from now and ready for our next panel. See you.
Obrigado a todos. Boa tarde.